Welcome to a continuation of our discussion of the environment and the theoretical structure of financial accounting. In this video, we're going to take a closer look at financial accounting and reporting. Who are the primary users of financial accounting information? These are the investors and creditors, both current and potential investors and creditors. Again, think back to the diagram we developed in the last video where you had those capital providers. These are the investors and the creditors. There are also secondary users of financial accounting information. Government agencies such as the IRS, regulatory agencies such as the Securities Exchange Commission, customers, suppliers, labor unions, financial intermediaries, and many other secondary users of financial accounting information. If you're wondering why, for example, suppliers might use the financial accounting information of a company, most of these companies operate under just-in-time inventory. So suppliers must know if you're the provider of their inputs for their manufacturing that you're going to be solvent, you're going to be in business. And so they look at the financial information to get comfortable with the company as a supplying partner. And then what are the primary means for conveying financial information to the external users, financial accounting information? It's the financial statements, we'll talk about them in detail in this course, and related footnotes to the financial statements that we develop and provide. Here are the four required financial statements. The balance sheet, also known as a statement of financial position. The income statement, also known as the statement of operations. The income statement includes the statement of other comprehensive income. You'll learn what that means in this course. Statement of cash flows, and the statement of shareholders' equity. Those are the four required financial statements, and we're going to learn how to prepare those. Okay, introduction to a couple of terms here. Cash basis versus accrual basis accounting. The cash basis accounting is a key measure. The key measure in cash basis accounting is net operating cash flow. Basically, your checkbook is a cash basis accounting system. It's the cash receipts minus the cash disbursements. It's, of course, a key measure over the life of the company. But it's often not indicative of the company's long-run cash-generating ability in the short term. Let me describe why that is so. Scenario one. Think about your building inventory levels for huge expected sales coming up in future quarters and in future years. That's a very positive development. But in the short run, we're going to put out a lot of cash to acquire that inventory. Hence, on a cash basis of accounting, the profitability of the company is going to look quite negative, possibly. But in the future, we're going to sell all that inventory for great sales profits. Here's another scenario. We're building a factory, and this factory will help us generate profit for years. But in the current year, we're paying a lot of money to build the factory. Hence, the company won't look profitable this year. But when that factory is up and running, the company will be making a lot of money. Accrual accounting is going to account for those issues. Accrual accounting is the key measure in accrual accounting is net income. Remember, the key measure in cash basis accounting was the net cash flow. Accrual accounting is going to be more useful information for predicting future cash flows. It's a better reflection of the underlying economic performance of the entity in this period. It measures resources provided by the operations, we're going to call those revenues, and it measures resources used to produce those revenues, which we call expenses. Net income is those revenues minus those expenses. Again, let's revisit the scenario 1 and 2 above. When we're building inventory, well, inventory is expensed when those units are sold. Thus, we match the cost of that inventory against the revenues that we generated by selling it. As opposed to the cash outflows that occurred when we bought the inventory. When we buy the inventory under accrual accounting, we set it up as an asset that's going to bring us future benefits. Scenario 2 above was building a factory. Well, under accrual accounting, what we're going to do is we're going to make we're going to record that factory as a big asset called property, plant, and equipment. And then we're going to depreciate it over many years, over all the years that it's going to help us to generate revenues. That will match the cost of that factory against the revenues it's helping to generate. So we're going to see that very soon in this course. All right, let's talk about the development of financial accounting and reporting standards. Generally accepted accounting principles are a dynamic set of broad and specific guidelines, sometimes broad, sometimes specific, that companies should follow when measuring and reporting the information in their financial statements and in the related footnotes to the financial statements. The use of generally accepted accounting principles across companies allows for comparisons across those companies. In other words, the generally accepted accounting principles are a set of rules that everyone is applying. Hence, it makes two organizations more comparable. We will learn many of the generally accepted accounting principles in this course and in Financial Accounting Reporting 2, 3, and 4, as well as in cost accounting. So the obvious question is, who establishes these rules? Who establishes generally accepted accounting principles? The Securities and Exchange Act, the Securities and Exchange Commissions Act of 1934 established the Securities and Exchange Commission. By the way, in the last video, I think I might have said the 33 Act. Remember, from Legal Environment of Business, there was two large acts, the SEC Act of 33 and 34. It was the 34 Act that established the Securities and Exchange Commission we spoke about in that last video. In general, both of these acts are designed to make the capital markets operate efficiently and effectively. Congress gave the Securities and Exchange Commission the authority to set accounting and reporting standards for companies that have securities that are publicly traded. The Securities and Exchange Commission delegates this authority to the private sector. Currently, it's an entity called the Financial Accounting Standards Board that sets the standards. Of course, the SEC, the Securities and Exchange Commission, does maintain ultimate authority. Okay, so let's learn a little bit more about this Financial Accounting and Standards Board. This is the Financial Accounting Standards Board, again, is the entity that the SEC relies upon to develop the generally accepted accounting principles or the rules of accounting. It's comprised of 7 full-time members. These full-time members have no affiliation with other organizations, and that is so that we avoid conflicts of interests. They represent various constituencies in the process. There is a member from the auditing profession. There's members from corporations. We call those preparers. There's financial analysts. Remember that upper right box on our picture? That's where financial analysts rest, as well as at the financial intermediaries. There's an accounting educator on it at all times. Currently, that's Dr. Christine Bodison, as I speak in 2024. And there's also a member from government accounting. The FASB issues new guidance via Accounting Standards Updates, or ASUs. The FASB, the Financial Accounting Standards Board, also has an Emerging Issues Task Force to resolve accounting issues that require quick action. The ASUs are developed in a very deliberative process, a very impressive deliberative process. We'll talk more about that. So it takes a while. Hence, there's an Emerging Issues Task Force if something needs to happen really fast. And then the Financial Accounting Standards Board will take it up on a future agenda item. Okay. Now there's this thing called a codification. It is a conglomeration of all the generally accepted accounting principles. It's a searchable online database. It's the comprehensive set of accounting principles. It's the comprehensive set of accounting rules. It's the comprehensive set of GAAP. It integrates and topically organizes all relevant accounting pronouncements. It categorizes them into 9 main topics and then approximately 90 subtopics. The codification is located at www.fasb.org, and we will provide you with free access while you're a student here. So you'll be searching and you'll be able to see the codification a lot. Here are those codification topics. The 100s are the general principles. The 200s involve presentation of financial accounting information. The 300s involve asset accounts, accounting for the assets of the company. The 400s involve accounting for the liabilities of the company. The 500s involve accounting for the equity of the business. The 600s relate to the revenues, accounting for revenues at a company. The 700s relate to the accounting for expenses of the company. The 800s are several broad transactions, discusses several broad transactions. And the 900s are industry-specific accounting rules. There's also a Governmental Accounting Standards Board. It was created to develop accounting standards for governmental units. There's also an International Accounting Standards Board. Again, remember, this is all under the development of financial accounting and reporting standards. So we asked, who establishes GAAP? These are the entities. The International Accounting Standards Board, as you can imagine, they develop the international accounting standards. The GASB, the Government Accounting Standards Board, develops the standards for governmental units. A little more about international. The objective is to develop a set of high-quality, understandable, and enforceable global accounting standards to help participants in the world's capital markets and other users make economic decisions. It has 14 members. More than 120 countries and jurisdictions globally require or permit the use of international financial reporting standards. Examples include the countries of the European Union. They use IFRS. Canada uses IFRS. Hong Kong, Australia, and Egypt. They all use international financial reporting standards. So how do we compare US GAAP and IFRS? US accounting rules and international financial accounting rules, most rules are the same or very similar. There are some important differences, though. Key differences will be seen occasionally throughout your courses. If you take Financial Accounting and Reporting 4 with me, I have a module that summarizes all of these differences and teaches us how to adjust for the differences. And of course, within these courses, your professors will also refer to these differences and talk a little bit about them. Okay, so let's talk about the Financial Accounting Standards Board's standard setting process. So the Financial Accounting Standards Board, when it's going to set a standard, it identifies a potential issue. It then decides whether to add the project to the technical agenda. Once it's on the technical agenda, the board deliberates at least one, and usually more, public meetings. Eventually, the board will issue an exposure draft, and invite comment on that exposure draft. The board then holds a public roundtable meeting on the exposure draft so that it can better inform you as it invites comments from you and your organizations. We could respond to an exposure draft as a class. I've responded to exposure drafts in the past. The FASB staff then analyzes these comment letters, these public roundtable discussions, and any other information. The board then redeliberates any proposed provisions at a public meeting. Ultimately, then, the board issues an accounting standards update describing amendments to the accounting standards codification. That's the process. As you can see, it's deliberative. It takes a while, but they do a great job. There's also a public company council that makes some accounting rules. These are standards established to best serve the interest of publicly traded. The standards established above are established to best serve the interest of publicly traded companies. The publicly traded companies tend to be huge. The Private Company Council is established to determine whether practical expedience can be sufficient for the tens of thousands of small companies. Any exception or modification proposed by the Private Company Council must be endorsed by the Financial Accounting Standards Board before being issued as an accounting standards update and added to the codification. So here's the deal on Public Company Council. If you're a small company, and it is very, very, very unlikely you're ever going to be a publicly traded company, there are a lot of rules that were developed for those publicly traded companies that are quite complex and quite expensive to implement. Thus, for companies that are not publicly traded and will not become publicly traded companies, we offer, the Public Company Council develops these expedients, these simplifications, where the information isn't as sophisticated, but plenty sufficient for the information needs of the capital providers to those small companies. So you'll see some examples of that. Okay, now let's look at the role of the independent auditor. Remember, we introduced the independent auditor in the schema that we developed in the last video. The role of the independent auditor is to express an opinion on the compliance of the financial statements with these generally accepted accounting principles. The opinion regards whether the statements present fairly the company's financial position, its result of operations, and its cash flows in compliance with those generally accepted accounting principles. In other words, it opines on two matters. Were those rules followed? Were generally accepted accounting principles followed? And when estimations were necessary, were they made fairly? Even in this course, we're going to see many estimations are required, and we're going to learn a little bit about how they're made. They're actually the especially interesting part of the ongoing accounting process. The independent auditor increases the confidence of those that rely. Increases the confidence of those that rely on this information. And therefore, auditors, we play a crucial role in the capital markets. To this end, auditors and CPAs are licensed by states to provide these audit services. Many of your professors here are licensed CPAs, including me. The role of ethics in accounting. We have got to be upstanding. We CPAs have got to be beyond reproach. Ethics refers to the ability to distinguish right from wrong. A code or moral system that provides criteria of evaluating right and wrong is ethics. The ethical dilemma arises when an individual is faced with a decision that tests this code. Accountants face ethical dilemmas from time to time. For example, there might be pressure to artificially inflate earnings slightly in a particular quarter to meet some earnings targets. We'll see what those earnings targets are. Ethics is expected for professional accountants and CPAs. It's necessary. We have a responsibility to serve the interests of the users across the globe. The global capital market participants are depending on you. So you need to be ethical from this day forward. The CPA credential, your reputation is a very, very valuable and lucrative credential. Don't do anything to tarnish it. Start today. And here's an analytical model for ethical decisions. I used a phrase earlier that you may have caught. A person should be upright, not held upright. You should be upright, not held upright. You should do the right thing when nobody's watching, not just when someone is watching. Because if you're doing something, you're doing the right only when someone's watching, you're being held upright. You need to do what's right even when no one's watching. The motivation to behave ethically should be both in your heart and in your brain. You should not be simply seeking to avoid violating a professional code or law. Hold yourself to a higher standard. Is it legal? Is it within the rules? But most importantly, is it the right thing to do? Steps for dealing with an ethical dilemma. Determine the facts of the situation, the who, what, where, when, and how. Identify the ethical issue and the stakeholders impacted. Stakeholders may include shareholders, creditors, management, employees, and the community. Identify the values related to the situation. For example, honesty. Is it honest? Is full disclosure being provided? Is confidentiality being protected? And there are many other values that are going to come into play. when you are faced with these ethical dilemmas. Then, after you've identified you've determined the facts, you've identified the ethical issue, you've identified the potentially impacted stakeholders, you've identified the values related to the situation, identify alternative courses of action. Evaluate these courses of action that you've chosen in terms of the consistency with the values you identified in step 3. Identify the consequences of each potential course of action. Indeed, identify the consequences for each key stakeholder involved and specify all the consequences by stakeholder. And then, given all of this, make your decision and take the indicated action, the implied action. A little plug here. University of Missouri St. Louis has an accounting ethics course if you have not yet fulfilled your ethics requirement. It's Accounting 2430 at the University of Missouri St. Louis. Increasingly, universities will have a specific accounting ethics course. If they do, please choose it. If not, there's excellent ethics courses offered through business schools and through philosophy departments. So take ethics courses and take them seriously. They're very, very important, very valuable. Okay, let's turn our attention to the conceptual framework. Now, what in the world is the conceptual framework? The conceptual framework it does not prescribe the rules per se. It provides the underlying foundation for the development of these rules. The conceptual framework is disseminated by the Financial Accounting Standards Board through the Statement of Financial Accounting Concepts. The objective of the conceptual framework is to provide financial accounting information that is useful to capital providers. That's the objective of the financial statements, and the conceptual framework is going to be designed to meet that objective. The objective is met via the following financial statement elements. These are prescribed in Statement of Financial Accounting Concepts number 6. The assets, the liabilities, the equity, investment by owners, distribution to owners, revenues, expenses, gains, losses, and comprehensive income. These elements are organized into financial statements. So, when we're providing financial accounting information, we meet this objective by organizing the information into these categories and then summarizing them in these financial statements: the balance sheet, the income statement, the statement of cash flows, the statement of shareholders' equity, and then the related footnote disclosures and other aspects of the annual report. Okay, so let's look at the fundamental qualitative characteristics of the information per the conceptual framework. The primary characteristics of financial accounting information are that it must be relevant and it must be faithfully representative. Relevance and faithful representation are these two primary characteristics. What's relevance? Information is relevant if it has predictive value, that is, it helps inform predictions of future cash flows, and it has confirmatory value, that is, it helps investors confirm or revise their prior assessments. What makes information faithfully representative? Its faithful representation is achieved if there's agreement between the measure and the underlying economic reality. So, An economic reality might be total sales. Is our measure of total sales, does it reflect the underlying economic reality? Does total sales on the income statement in the sales account represent the economic reality of the sales of the company that period? Faithful representation, faithful representation is achieved if the information is complete, it is neutral, that is, it is free from bias, it is not designed to achieve an outcome or to favor a particular group, and it is free from error, free from material error. So it's faithfully representing the underlying economic reality if it's complete, neutral, and free of material error. So those are the primary characteristics. Here's some enhancing characteristics. The enhancing characteristics of financial information are comparability, verifiability, timeliness, and understandability. Comparability implies results for different periods were developed using the same policies. Verifiability implies that independent measurers would come to a similar conclusion. Timeliness implies the information is available to users early enough to allow them to use it in their decision process. They're getting it in time to make the relevant decision. And then understandability means that the users are able to comprehend the information we provide them. All of these are considerations as we prepare the rules and indeed as we prepare the information for the capital markets. Now, all of these considerations are subject to the cost effectiveness constraint. If the cost of developing information is not justified by the resulting informational value, then we're going to forego producing the information. Is it worth it? Is the cost of developing this information going to make a big enough change in people's decisions that it justifies that is justified by the value it's going to provide in the information? Here's an example. You're going to learn that we expense long-lived but inexpensive assets, such as a wastebasket. Well, my question for you is, hey, that wastebasket's going to help us for years. My goodness, I've had wastebaskets for decades. So are we going to capitalize and record the wastebasket as an asset and then depreciate it over 25 or 30 years? No, that's not worth it. The difference is not going to be big enough in the financial statements if we capitalize the asset, the wastebasket as an asset, and then depreciate it over years versus just expensing that inexpensive asset this year. I hope that makes sense. Make sure you let me know if it does, if you need more examples or better examples, different examples. Here's the elements of financial accounting statements. This is Statement of Financial Accounting Concept 6. And we're going to look at these in this course. Assets. These are items of value the company possesses. They're probable future economic benefits obtained or controlled by an entity as a result of past transactions or events. Liabilities. Liabilities are amounts we owe to another entity, obligations we have to another entity. These are probable future sacrifices of economic benefits arising from present obligations of an entity to transfer assets or to provide services to other entities in the future as a result of past transactions or events. We're going to see plenty of examples in this course. Equity. The equity is the net assets of the business. It's those total assets minus total liabilities, also known as stockholders' equity. It's the residual interest in the assets of an entity that remains after deducting all the liabilities. Investments by owners. These are capital contributions by the owners. These are increases in equity of an entity resulting from transfers to it from other entities, transfers of something of value to obtain or increase an ownership interest. Investments by owners are recorded in contributed capital accounts, known as common stock and additional paid-in capital and other such names. So these are amounts that were provided by our owners, and then in return, the business has the cash, the capital, and the owner has an ownership interest, an ownership stake in the business. Distributions to owners. These occur in the form of dividends. These are decreases in equity of the business resulting from transfers to owners. This is returning some of the capital to the owners. Comprehensive income. This is the change in equity of an entity during a period from transactions and other events and circumstances from non-owner sources. Comprehensive income includes all changes in equity during a period except those resulting from investments by owners and distributions to owners. You're going to see examples of that in this course. Revenues. Revenues are our sales, the business's sales to customers. Its inflows are other enhancements of assets of an entity or settlements of its liabilities during a period from delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. Expenses. The expenses are the expenditures incurred by the business to run the business. More formally, it's outflows or other using up of assets or incurrences of liabilities during a period as a result of delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. Gains. Gains are increases in equity from peripheral or incidental transactions of an entity. This is like investments in the securities of other companies. Losses. Losses are decreases in equity arising from peripheral or incidental transactions of an entity. Okay, so what's the difference between gains and losses and revenues and expenses? Revenues and expenses, these occur from the things the company is there to do. If we are a restaurant, the revenues are the cash we receive from selling food, selling drinks. The expenses are the expenses to provide the food, make the food, provide it, serve it, provide the drinks, buy the drinks. Those are the revenues, and they're central operations of the business. A gain or loss would be if the restaurant also invests in stocks or bonds, or maybe maybe they discovered oil in the back property of the restaurant. Anything. That's of course a very extreme example, but it's something peripheral or incidental. It is not the central operations of the business. Okay, let's look at recognition, measurement, and disclosure concepts. When should financial statement elements be recognized? That is to say, recorded in the company's accounting records. How should financial statement elements be measured and disclosed? Okay, those are the questions we're asking. And here's the terminology. Recognition. Recognition is the process of admitting information into the financial statements. When you debit or credit an account, you are recognizing it. Measurement. This is the process of associating numerical amounts with these elements. Disclosures. Disclosures include information in the financial statements and the accompanying footnotes. Sometimes the accompanying footnotes aren't numeric, they're just information. So information can be recognized and disclosed, or just disclosed in a qualitative note. So when is it recognized? An item should be recognized in the financial statements when it meets the following 4 criteria. Again, subject to the cost effectiveness constraint and the materiality threshold. It meets the definition of the element. For example, the definition of an asset, or the definition of a liability, or the definition of revenue, or the definition of expense, or definition of gain or loss. It's measurable. The item can be measured with sufficient reliability. It's relevant. The information about it is capable of making a difference in the decisions of our users. And it's reliable. The information is representationally faithful, it's verifiable, and neutral. If it meets those 4 criteria, we will recognize it in the accounts and in the financial statements. And we'll see several examples of things that are recognized and are things that are just disclosed. Revenue recognition. The revenue recognition involves the timing of revenue recognition, and it's crucial for accurate performance measurement. Revenue is recognized when goods are transferred or services provided to customers. Revenue is recognized at the amount the company expects to be entitled to receive in exchange for the goods or services it provided. Revenue can be recognized at a point in time or over time. Examples would be when you purchase something at Walmart or Target or Amazon. Well, Amazon does have to be delivered, but when you purchase something at Walmart, when you walk out, they can recognize the revenue for the sale they made to you. Apartment rentals, that revenue is recognized by your landlord over time because it is earned daily. Asset recognition is related to revenue recognition because the recognition of revenue will bring an asset into the company. Okay, we're going to look at this in Chapter 6 in great detail in this course. So that's a little preview to Chapter 6. Expense recognition. Expense recognition attempts to match the revenues and the expenses. So it attempts to match the revenues and those expenses that arise from the same transactions. It's based in a cause and effect relationship. For example, the cost of goods sold is the expense, what the company paid for the good it just sold to the customer. Expense recognition involves associating the expense with the revenue recognized in a specific time period. Expense recognition is systematic and rational, can involve systematic and rational allocation to time periods. Example there is depreciation. You'll see that in your upcoming courses, including this one. Expense recognition can also occur in the period incurred. This is when it is not possible to determine which periods the expenditure will help the business. Measurement, a little more on measurement. An amount must be measured to be recognized in the financial statements. There are several potential measurement models you're going to see in your upcoming courses. Historical cost is one of those, what we paid for the asset, what was paid for the asset. Net realizable value. You're going to see that in a later module in this course. We're going to learn about that. That's another potential measurement basis. The present value of future cash flows. We're going to talk about that later in this course, and you'll talk about it a lot in financial accounting reporting too. Another basis of measurement. And then fair value. Fair value is associated with investments especially. You'll see when that is used as the measurement basis. And then there's also a current cost measurement basis. This is used in special circumstances, such as inflationary economies. It involves what it costs to replace the asset. Little note here. Increasingly, companies are being given the option to choose fair value for financial statement items, the fair value basis of measurement. All right, so you're going to see all of those in upcoming modules in this course and on upcoming courses. Disclosure. The goal of disclosure is to provide information that is useful to decision makers. Much additional information is provided via disclosure rather than recognition in the financial statements. You'll see why we choose to disclose rather than recognize. Disclosures types will include parenthetical comments or modifying comments placed on the face of the financial statements, like the balance sheet and the income statement. It might take the form of disclosure notes conveying additional insight about company operations, accounting principles, contractual agreements, maybe pending litigation. It might take the form of supplemental schedules and tables that report much more detailed information regarding something that is information that is provided on the primary financial statements. Again, like the income statement, the statement, the balance sheet, the statement of shareholders' equity. Okay, so that's what disclosure refers to. You're going to develop many disclosures. Now there's something called an asset liability approach. The asset liability approach is a general approach, and it underlies the current accounting rules. They place an emphasis on ensuring that the balance sheet items reflect the economic reality at that balance sheet date. You will see this emphasis in a lot of topics across our curriculum. One notable place you'll see this is accounting for income taxes in the financial statements. Keep that in mind. In Financial Accounting and Reporting 3 is where you'll cover that in great detail. And you'll see that we're going to make sure that the income tax items, related items on the balance sheet are absolutely perfect. And then we'll let the income statement impact fall from that. Okay, so keep that in mind. That's a preview to something you're going to learn in Financial Accounting and Reporting 3. All right. So often we'll have assignments at this point. We have none in this module. Your assignment is to make sure that you paid excellent attention to this. These are very important foundational concepts. And these are going to underlie all of the discussions in this course and all of your upcoming courses. So this is crucial information. Thank you for your attention. Most of these videos will not be nearly this long, but this is an important one to make sure that everyone is ready to deeply learn the upcoming concepts. Again, thank you very much for your attention and have a wonderful day.